All right. Hello, everybody, and welcome to MacroAce with your host, Tony. Thank you very much for joining me for this session. We've got quite a bit to cover, and I'll just bring up the little window in the presentation for us. But hopefully, everyone can see my screen clearly. Nothing's in the way. Okay. Presentation. Okay. All right. Okay, so as I said, thank you very much for joining me. Don't forget to like and share the video with your fellow traders and friends who'll be interested in getting some preparation or prep for the FOMC rate decision. So let's go through this here then. So FOMC, what's it all about, right? So the FOMC is a group of Federal Reserve members that meet roughly 6 weeks over 2 days and decide where to set the interest rate and monetary policy, okay? So again, of course, what we have is that the rate that the bank charges each other to borrow or lend excess reserves overnight. So that was the old range that we had there. Now, of course, you can see how much we've changed since then. This is back about 3 meetings ago now that we had. That was the current range then, about 4 meetings ago. What else do we have? So why is the interest rate an important rate decision? Why is it so important to the markets? Not only to the markets, but also to the global economy too, and other central banks, and of course, US citizens and businesses as well. So it causes volatile moves in the markets and affects the wider economy. It may also influence other central banks to follow in a similar rate path, and we've seen that very evidently with the Federal Reserve. And they've been taking an aggressive rate hiking path, which has led to other central banks taking a similar path as well, or some central banks trying to play catch up or try to be as tough as they can with the interest rates. Of course, you had the Bank of Canada, notably when they had their rate decision going by a 50 base point rate hike rather than the 75 base point rate hike. Some people are saying that could be that could mean that the Federal Reserve might be going for 50, but there's been no inclination of that for this meeting, especially that the Fed would go for 50. Everyone's looking at a 75 base point hike. Nobody's really looking from the big investment, from the big boys. Nobody's really looking at a 75, and nobody's looking at a 50 base point hike because the Fed had said previously that they would want to see at least. They would want to see at least one 75 base point hike before the end of the year. So how does it affect the markets then? So what's important for you guys to know and understand with the FOMC rate decision? So the currency, so the dollar might rally if the Fed is showing an inclination to continue to raise rates or continue to raise rates. How much the dollar moves depends on if the FX markets have taken these hikes into consideration or if they've already priced in the rate decision. So a lot of what's been happening with the dollar since the last FOMC and recently as well is our markets have been trying to price in the 75 base point hike from the Federal Reserve. That's expected later on in about 56 minutes to be precise. Now, of course, if the data comes in higher or lower than expected, if we get a bigger rate hike than expected or a smaller rate hike than expected, then that will cause an extra amount of volatility and create some very volatile moves within the markets. So for stocks then, very easy. If the Federal Reserve or central bank is raising interest rates and you get a rate that is much higher than expected, you see that the stock market will see depreciation because they've already been trying to price in a certain interest rate hike, right, over 75. If we do get a 100 base point hike, then that's going to cause extra fear in the markets that, the Federal Reserve may continue with their rate hiking path. Okay, so you could see a bigger drop down in stock indexes, or some people could take that as that, okay, the Federal Reserve is taking a 100 base point hike now, so that later in the future, they can take smaller rate hikes. Okay, so there's two scenarios there. But either way, if you do see a bigger rate hike than expected, you would likely see a bigger depreciation from the stock indexes. But if you see a smaller rate hike taken, like a 50 basis point hike, which none of the investment banks are predicting or forecasting for this meeting, then you would see a big appreciation from the stock markets, because it says that the Federal Reserve doesn't need to continue with a super aggressive rate hiking path, and they can actually slow down that pace to going by 50 basis point rate hikes. Then eventually, maybe, as what a lot of people have been saying and what they've been talking, and also Federal Reserve members, so maybe to look at early next year as to where the Fed could pause with their rate hiking path. So Random said where to watch the FOMC live directly. You can on the FinancialJuice news feed, so you can have a look at that. We'll put out the video for the FOMC on the for the press conference, but you can look at the headlines live in real time and also get the voice in real time as well. So that's the stock market. Now with the bonds, so usually for the bond market, investors might flee long bonds if rates rise, as it could mean that inflation is on the rise and they may instead chase the shorter term securities. As the sale of bonds accelerates, their yields also rise. And once investors grow confident that monetary policy is working and inflation appears steady, they switch to buying bonds again to lock in the highest yields possible. So one thing to consider as well, and if you've been living under a rock for quite a bit of time now, you should know that when interest rates are raised, or the expectation for interest rates to be increased or hiking path, that the bond yields usually will have seen an appreciation, because bonds are very closely linked to what the Federal Reserve does. The government will set a bond at a certain price with a certain yield. So if the Federal Reserve decides to hike interest rates, then the government is very likely to raise the yield that an investor can borrow from it. And also traders too, in the longer term markets, in the long term bonds, they will also look to buy bonds with longer term with higher yields. Of course, for what we're looking at with the bond prices, you would see depreciation in bond prices. So remember, the lower the bond price, the higher the yield, and vice versa. That's how the bond market works if you're unsure of how it does. Then, what do we have? So where is the economy at the moment? So not too many indicators to look at, but just kind of the main things that we need to be aware of. So GDP third quarter advance, right, is at 2.6%. So much better than the second quarter data that we had at minus 0.6%. So the economy clawed its way back into the positive territory in regards to productivity. Inflation, this is the key point for what every central bank is focusing on, the big I, right? The big I, the inflation figures that an economy is currently experiencing. So this is the CPI year-on-year figure here for inflation, CPI year-on-year. So currently at 8.2% in the US versus 8.3%. So lower, but still quite sticky. Okay, it's not really, you're not seeing significant downside moves in inflation like we've seen in Canada, right? Where we've seen, I think, about 0.6% drop in their inflation figure at one point when we had data from them from last time. But still quite sticky, are hovering around that 40-year high in the US, meaning that the Federal Reserve, of course, they haven't flipped their switch and said we need to we need to pump the brakes on our aggressive rate hiking path, but still quite high at the moment, and more than 4 times what their inflation target is of 2%. So the PCE price index year-on-year unchanged at 6.2%, which is the Federal Reserve's preferred measure of looking at inflation and where it's expected to, and then they make their own forward guidance where it's expected to be in the future. And the consumer spending month-to-month ticked up to 6%, prior was 4%. Non-farm payrolls slightly weaker than the previous report, came in at 263k versus 315K. ISM manufacturing PMI, what we had recently this week. So it came out at 50.2 versus 50.9. So a deceleration, but as always, a figure above 50 shows that the economy or the manufacturing sector is expanding. Anything below 50 shows a contraction. And what economists say is that if you go to 47, then that means you're in a recessionary territory. Excuse me there. University of Michigan sentiment finals wall 59.9 versus 59.8. Of course, consumer expectations is also quite key to what the Federal Reserve does with their rate hiking path as well. The 1-year inflation final was also at 5% versus 5.1%, and the 5-year inflation unchanged at 2.9%. Amin said, "The hell was that?" Yeah, that was me just mispronouncing recession. I said recession. Don't worry, that's not the mic playing up. That was me playing up. All right. So inflation pressures or expectations are still more or less unchanged at the moment. So that's not really, it's kind of hovering around there. You're not really seeing any significant drops in inflation expectations, particularly the 5-year inflation expectation, right? We'll look at the summary of economic projections from the Federal Reserve too, and you can see how they also expect inflation to still be at around 2%, even in 2025. So the previous FOMC statement then, or the rate decision that we had. So of course, so what they said was that in recent months, job growth has been robust and the unemployment rate has remained low. Inflation remains high, reflecting pandemic-related supply and demand imbalances, higher food and energy prices, and broader price pressures. Furthermore, the committee will continue to sell treasury securities, agency debt, and mortgage-backed securities. Then Fed's Powell's comments as well on the 21st. So he said they're quite likely to see a period of substantially slower growth. Median policymaker sees 125 base point hikes by the year end. But there was a sizable group that would see 100 base points by the end of the year. Soft landing is incredibly difficult, and no one can predict whether it will result in a recession or how severe it would be. Given the high inflation, we believe we need to raise the funds rate to a restrictive level and keep it there for some time. So I believe, we're already, getting, in my own opinion, we've entered the restrictive territory, of course. But of course, there's still a lot of work to be done. If inflation is at 8%, and there are people talking about the idea of a Fed pivot, it's quite difficult to say, maybe early next year is the time to go for the Fed to pivot with their policy, because the data hasn't really shown that as of yet. Yes, maybe in the real economy, people might be feeling the aggressiveness of the Fed's rate hiking cycle. But if you're solely looking at the figures that you're getting with strong non-farm payrolls figures, okay, inflation is still quite hot, hovering around 40 highs. That doesn't really change the Fed's view or stance to say we need to pump the brakes now. But you never know. It could change. You never know what could happen with the FOMC or what Powell could say. Remember, the rate is, the FOMC rate statement is as important, if not maybe more important, than the rate decision itself to give a detail as to why the Fed had gone with their decision. October 12th, then, the Fed minutes. So participants agreed that at some point it would be appropriate to slow the pace of rate increases while assessing the cumulative effects of policy adjustments, something that's been said a couple of times before in the meeting minutes as well. So it's not completely new that, they'd say it's appropriate to slow the pace of rate increases at some point. Fed officials determined that they need to adopt and maintain a more restrictive policy stance in order to achieve their goal of lowering elevated inflation. Also, don't forget, again, if you're joining me now, then just jump on. Of course, get your friends and fellow traders to jump on. If you're finding this stuff awesome and useful, then definitely share this with everyone. that you know, get them into it. And don't forget to like the video too. So many participants emphasize that the cost of doing too little to reduce inflation outweigh the cost of doing too much, meaning that if they do what they did back in in the 70s of being premature with their rate hiking or with their rate reducing path or pausing the rates, and then they let inflation get out of control, then that's something that what they're saying there is that they don't want to do that. They want to make sure that they actually get inflation to around to 2% or slightly lower or around it, and then they can start to consider some other forms of maybe maybe starting their rate cutting path. If of course, by that time the economy is going to be pretty hammered by then. By the time we get to where the Fed wants to get to, with their Fed funds rate. But before that, that's what they've currently said. So doing too little to reduce inflation outweighs the cost of doing too much. Several participants predicted that as policy became more restrictive, risks would become more two-sided. Of course, just what I said, the stronger rate hiking path that the Federal Reserve takes, the more damage it's likely to do to the economy in a short period of time, and potentially let it damage the economy for a much longer period of time than what the Fed would predict it to do. Then the Fed voting members, right? What are the comments that we had from them over the last 6 weeks or so in the lead up to today? So October 14th, Bullard said that the Fed could decide to move the 2023 tightening into 2022, so i.e. going with, continuing with their aggressive rate hiking path of doing 75 basis point hikes, maybe even a 100 basis point hike at one of the meetings. Maybe today or December, right? Rather than doing some extra hikes in 2023. So the appropriate rate range, as he said, should be in the 4.5 4.75% range by the end of the year, with any further increases in 2023 being data dependent. Adding that I would not predict that policy rate needs to reach 5%. If that becomes necessary, it'll be due to inflation not slowing as expected. That's the key point here. What do they mean when they say not slowing as expected? Of course, you can get declines every month, right? But do they mean big declines like what the Bank of Canada has seen in the past with one of their reports, and then they see a continuation of a gradual decline? Or do they mean they need to see several reports of big declines in inflation before they decide to switch up or pivot with their rate hiking path? So that's one scenario that's presented from Bullard. On October 11th, Mester says, I do not anticipate the Fed lowering interest rates in 2023. Adding on September 12th, what she said earlier on the September 29th, saying that she's probably slightly above the median path reflected in the September projections. October 10th, Brainard said that premature easing a risk, but risks may become more two-sided at some point, and for a while, monetary policy will be restrictive. Fed's Cook said that it may be necessary to slow the pace of rate hikes at some point. Inflation of core goods prices should slow in the coming months. Fed's Collins on September the 26th said that inflation is most likely nearing or has already peaked. Fed's George says that we must enter restrictive territory. How restrictive remains to be seen. Also on October 14th, George says that Thursday's inflation report served as a reminder that we still have work to do on inflation. So again, nobody's really saying that, that there needs to be a pause at some point, or inclining that there should be a pause. The only thing you could take away is that Fed's Collins said on October 26th that inflation is most likely nearing or has already peaked. But does that mean you're going to have a slow decline of inflation, or big drop in big declines in inflation reports that we have coming up later on in the year. So that's another thing to consider as well, is that, is Fed's Collins, has he, when we get the Fed minutes later on in the year, has it really changed his views with the recent CPI reports that we've had and the upcoming CPI reports that we get? Oops. Non-voting Fed members. So Fed's Evans said that he sees a Fed funds rate rising to a bit more than 4.5% by early 2023 and remaining there for some time. Fed's Daily said that as a neutral estimate, she'd go with 3 to 3.5%. And according to projections, the policy will be tightened to 4.5 to 5.5% next year. So there's still quite a bit of tightening to go. Basically, her neutral estimate is out of whack. Doesn't really make sense, because if we do go with, the 75 basis point hike, we get to 4%. Even with a 50, 3.75, then basically that estimate would have been crushed pretty easily. October 5th, Bostic said it's on speculation of rate cuts in 2023, saying not so fast. October 18th, Bostic also said that employers are having difficulty finding entry-level workers. That's going to be quite key for wage prices. Okay, if businesses have to increase wages to try and attract those people into their workforce, or back into the workforce from being unemployed, then they're gonna, if they do have to increase their wages or keep them quite high, then that means that when those people do get a job, or do get a job or jobs, then they'll have a lot of money to spend on goods and services. So that cycle will, could continue to happen, where you have sticky inflation for quite a while until businesses start making change. But they can't, because they need those workers to provide the services and create the products that they need to make money, in order to keep GDP and also their businesses afloat as well, and rather than continuing to go into a downward spiral or losing their business altogether. However, you do increase wages, and you're having to do it out of necessity rather than the ability to be able to do it because you're comfortable with your finances, then that will lead to businesses that might have to close up shop earlier if they can't afford to pay wages. And then those workers will go to the bigger businesses instead. So the summary of economic projections that we got with the last rate session. So it indicated no rate decreases until 2024, and at least one additional 75 basis point rate hike in 2022. So here you go. So their inflation projections, right? PCE is what they use to provide what PCE price index is what they use to provide for their own forward guidance. So here you go, 2025, they still see inflation at 2%. If you compare it to June's projections, okay, it's core PC inflation as well, seeing it at 2.1%. So it's quite worrying that the Federal Reserve isn't going to get to their 2% much sooner than they would want. That is still going to take, about 3 years or so to try and get to that point. Then their Fed funds rate as well. Whoops, I just covered that. So the federal funds rate target as well. So 2025, they see it at around 2.9%. 2024 at 3.9%. 2023 at 4.6%. And of course, currently this year at 2023 at 4.6% and 2022 at 4.4%. So if you compare it to the June estimates here, you can see that they've been this year's estimations for rate hiking path was substantially increased, okay, from 3.4% to 4.4%, and then also for the other years, for the following years as well. So does it really make sense for the Fed to pause or pivot early next year if their summary of economic projections is showing a much higher rate hiking path than they previously expected? you can say yes, that they will that an early a pivot early in in early pause in early 2023 is isn't possible. But no, because you could say, like I said earlier in the video, they get to their Fed funds rate target much sooner than they need to, and then they can kind of see what happens and pause to the economy after they've got to their Fed funds target. But the other thing to know is that they've continually been updating and increasing their forecast for where the interest rates, where the Fed funds rate should end up. So what's to say that the Fed's funds rate expectation in the next summary of economic projections that we get when it does come out, that they don't increase it to a much higher level? You've had the likes of Ray Dalio, who I think he said around 5% is where he would, or 5.5% is where he would expect the Fed funds rate to be. And you've had other people too looking around 6 to 5%, money markets as well. Before we're looking at 5% as well, where the Fed funds rate would or could peak at. In my opinion, I think with where inflation is at the moment, we're not seeing big declines in the inflation figures, which doesn't give me a lot of confidence that, if you did decide to go with a 50, it's the key thing is the Fed wants to put off people from spending their money, right? Enough to slow down inflation and bank and businesses from borrowing money. So if they do need to continue with their aggressive rate hiking path rather than trying to ease the market tension, then it kind of makes sense for them to go with potentially a high rate hiking path instead. But that's just an opinion, not a fact. Of course, all of these here is just trying to provide you with the best image of what we have with this very volatile market that we're currently experiencing. So that was the summary of economic projections. Then views then. So BlackRock on October 27th, so an economist are telling financial advisors that the next Fed meeting will include pivot language. Fox Business reporter tweeted there. And they also added that they expect Powell to announce a 75 basis point hike, followed by 2 smaller ones and a pause to get us to around 4.75%. Now, if you were going to go down the path of that and say that the Fed, as they said, they want to see an additional, at least one additional 75 basis point hike, but then you would say, okay, they will do one more today. And then at the next meeting, then they'll go with a 50 basis point hike. But there was an interesting, there was an article that was put out, online from the Wall Street Journal, summarizing what had already been said by Fed members, but talking about an early, maybe early next year that they could pause interest rates or pause rates next year. Those comments were already made, but it still moved the markets. Surprisingly. So, it's kind of like, think of it like the dog whisperer, right? Some people call this dude like the Fed whisperer, but I kind of like to think that, you've got this person or the Fed's Powell, like pretending to be like the dog whisperer. Okay, no, don't put this out. No, put this out instead. Touching the guy's neck. Anyway, so then another view here too as well. So ING, October 28th, what they have here. So this is very good. This is the different scenarios that they provide of what could be said during the from the FOMC statement. Okay, so ING's base case scenario, okay, is that they see a 75 basis point hike, but open the door to slower hikes ahead. Quantitative tightening to be unchanged. They expect to be mentioned in the statement that inflation is too high, but monetary policy works with long and varied lags. In regards to growth outlook, their base case is they expect the Fed to say that sustained slowdown is expected, but the focus is still on inflation. So the dovish point, what a lot of people have been trying to, have been talking about, saying, yeah, maybe the Fed will do a 50 basis point hike at this meeting. If you were looking at that scenario, you would look for these sort of comments here. right? Over tightening could lead to a sharper and deeper fall in inflation. Recessionary forces are building modest signs of cooling jobs market. Of course, interest rate, they'll take a 50 base point hike instead. A worsening outlook justifies a slower pace of tightening, and QE with quantitative tightening, or QT. So it's not really cute, is it? Discussion of slowing reduction in response to market volatility is also another thing that could crop up to match the basically the scenario of a dovish scenario that could be presented. The hawkish side, right? If they go with a 75 base point hike with no forward guidance on the path for hikes, inflation is proving to be stubborn with risks still weighted to the upside. A growth outlook, they need prolonged period of below trend growth to bring inflation down, and QT unchanged. And then the very hawkish path would be that inflation, if they go with 100 base point hike, and the Fed signals clear intent to crush inflation. We must crush inflation. Or if that's Fed's Powell, he'll probably be like, we must crush inflation. So other comments too, if inflation is embedded and upside risks justify more forceful hikes. Growth outlook, recession required to have a material impact on inflation outlook, and with quantitative tightening discussion regarding swifter balance sheet reduction. So I think, that's their basic scenarios. Everyone's seeing a 75 base point hike. If you're looking for a more dovish central bank, then you'd expect comments about recessionary forces taking more of a stronger hold on the economy. If they over tighten, that could mean that there's a deeper or a bigger decline in inflation than they anticipated, and whether or not to slow down how much quantitative tightening that they do. More than likely, you could get a mix of going with a 75 base point hike and maybe talking about how the economic outlook could decline, but the discussion of quantitative tightening is that they're unchanged. So more or less, if they, key thing, if they say that inflation is expected to see much bigger declines in the future, that could be seen as a dovish thing. Okay. Even if they go with a 75 base point hike, that's why I say you have to look at not only where the rate comes in, if it's a 75 base point hike to 4%, but also the statement itself, and that's going to create a lot more volatility than maybe the rate itself. But if they do decide to go lower than expected or higher than expected, the rate alone will probably spook the markets by itself. And then the monetary policy the rate statement will add on top to that extra volatility, or that volatility that we see. So the last rate decision that we had then. So here was the reaction. So there was a question whether or not the Federal Reserve would go with a 100 base point hike or a 75. A lot of traders were pricing in a 75 base point hike, but let's play the video here. Would you bring it up? Okay. About 10 seconds before the release. I'll play the video here for you. All right, so there's a 75 base point hike as expected to 3.25%. You'd seen the market. Now, usually when the rate comes in as expected, you see a whipsaw, right? Or initial flash move to the up or downside. Then it's looking to the rate statement, right, to see what happens. So as said, initially you see a whipsaw in the markets. If you're watching this stream now, if you just jumped on, when this is not the interest rate at the moment, this is just the replay. Please don't get confused. If you do, I feel sorry for you. We still got about more or less 26 minutes till the actual rate decision. So here we go. So the reaction, lasted. It was more of a sustained move towards the downside. Not to say that that's going to happen. That the same thing is going to happen at this current, in this upcoming rate decision that we have. But that's one thing to just to be aware of that, you could see a bit of whipsawing from the markets. So if I kind of go ahead. Now, the reason why the S&P sustained its move towards the downside is because of the summary of economic projections, right? As I showed you earlier, if I just go back to the... Okay, there we go. So there we go. So Fed officials, the projected median Fed funds rate at the end of 2022 is 4.4%, up from 3.4% in June, and that they see an additional... they see one additional 75 base point rate hike by before the end of this year as well. So that's what caused the market, or the S&P, to continue its sustained move towards the downside, and the dollar to see a continuation of move towards the upside rather than a whipsaw reaction. So if you do see, the rate come in as expected, but you see like the S&P going up or down and continuing that movement, then it's something in that statement that's been said that's causing the markets to continue with a, oh my lordy lord, something's just been said by the Fed and now we're all scared. So that's one thing to consider. But if there's nothing surprising from the Federal Reserve or nothing scary that comes out, then you more or less could see more of a whipsaw reaction that we've seen previously when rates have come in as expected, compared to other rate decisions, compared to where the rate decisions where something has been said or has happened. So that was the last rate decision. If we kind of move forward, you can see, I think after about 8 minutes? It's about 10 minutes after the, about 10 minutes after the release. Let me have that on there. Okay, so you'd seen 159 ticks down on the S&P. Dollar CAD, there's about 45.5 move towards the upside. Gold, 85 ticks down. I think on the dollar yen. Anyway, we'll look at the deviations now. The highlight of what a lot of people have been asking for and have been interested in, right? Let's just get our screen set up as well. Get my TICKSTRIKE ready. We've got plenty of time. We're doing great for time. Get my US release set up, ready. Just get the S&P. Get it on the display as well. There we go. All right. Hopefully. Okay. Oops. There we go. It's a bit easier to kind of see the data or the reaction from TICKSTRIKE. All right. So deviations then. Let's bring that up. Okay, here we go. Hopefully, maybe I should just close down that TICKSTRIKE for now. So you can see this nice and clearly. All right. Deviations. What are you talking about, Tony? What are deviations? So deviations just show you how big the reaction was from an economic release or an event that had from an economic event, and depending on what the figure was or how big of a difference there was between the forecast and the actual figure, determines how much the market moved by, right? So of course, not only do we have by the way, there are a load of other releases that I cover for MacroAce and the deviations, but this is just data that I've input myself of how big the market reaction was, and what was the move 10 minutes after the markets had reacted to the initial release. So we can see here nice and clearly. So the sentiment was, right, the summary of economic projections sees at least 175 base points in 2022 with no rate cuts until 2024. So this is why he had seen a sustained move towards the downside on the S&P, and probably the biggest reaction that we've seen so far in the stock indexes this year from the markets. So you'd seen on the S&P 159 ticks down after about 10 minutes of trading. It was down by about 185 ticks. Nasdaq down 627 ticks after about 10 minutes of trading, still down 725 ticks. Gold was down 85 ticks and down 93 after 10 minutes. Now, currency pair-wise, if we're looking at what was the biggest currency move, what we can see here, it was cable with 63.5 pip move down on the initial candle. Remember, that's going to the wick of that first candle, right, to try and capture the initial move of what we had seen. And then the second large reaction we had seen from the currency pairs was dollar CAD, and then euro dollar, and then dollar yen. So this is quite interesting. So if we had the Japanese that were intervening in the markets, previously what we had seen in other major releases, like if I went to non-farm payrolls, kind of scroll down, what we'd seen is that there wasn't a big reaction on the dollar yen compared to some of the other currency pairs. Right, look at that difference. You have 24 pips, 24 pip move, and then an 18.5 pip move down on cable. Of course, there are other things with cable that were going on. Of course, you had Truss, who was elected as the prime minister and was now gone. As quick as she came, she quickly left, becoming the shortest serving prime minister. But you can see there was something going on in the dollar yen compared to the other currency pairs, where the dollar yen wasn't reacting as strongly compared to the other ones. Now we haven't seen the Japanese government or the Bank of Japan jumping into the market to try and ease the yen's pain, But if we, as one factor that could affect the markets today, if the Japanese do decide to intervene, because there's going to be an expected amount of volatility, a lot of volatility, if expectations are not met, or much higher than expectation or lower than expectation, then that could be a possibility. So you might not see a big reaction from the dollar yen as a possibility, right? But I'm yet to kind of see that with the big releases, whether or not that's still continuing. For the smaller releases like consumer spending, we'd seen a decent reaction from dollar yen, but I want to know what happens, if with the big releases, if it kind of confirms my theory that the Japanese will only intervene if there's a big amount of volatility that causes the dollar yen to see erratic moves happening. But as I said, as something that's happened in the past, we're yet to see if that happens today. But overall, cable, of course, back then, of course, you had cable having the issue, or Bank of England having issues with the bond market and gilt market, or you can call it the gilt market in the UK. And also the energy package that Truss wanted to bring about, the tax cuts during that time period he wanted to bring about as well, had an effect on the sentiment for the pound, and there was a loss of confidence in the pound as well, so you'd seen bigger reactions on cable. Now that's kind of cleared. You've got Sunak in, Hunt reversed all those policies that Truss had tried to implement, and you'd seen confidence return to the pound. So more or less, if we're looking historically, then what had seen the biggest move overall currency pair-wise, probably be, we can see it was quite a mix between the dollar yen and cable. So what had seen decent moves in the past. So here we go. If the rate comes in as expected, yeah, you do see a move, but it isn't, it's not really that big or crazy. You'll see an initial whipsawing, right, happening from markets. But of course, even if the rate decision comes in as expected, always looking to what the statement says as well. Right? Can't disregard the statement. That's why listening to a live voice and text service is very, very key. Okay, and I've put the link up there for you for the FinancialJuice Pro 7-day free trial they can have a look at. Of course, I've got the site up here and ready to look at the rate decision and capture the headlines. But that was but overall, this was the market reaction from last time. Now, if you want access to this, then what you can do is, and this data here that I have is completely free. Okay, you can sign up to the MacroAce mailing list to be able to receive the upcoming economic releases that we have for the week. Okay, so what does that mean? So what is the MacroAce mailing list? So MacroAce, the mailing list, and what we do is just provide one email every Sunday of what to expect for the week ahead, the economic releases that we'll be covering, what to expect in the Asia, Europe session or US session, and then also providing the deviations for the upcoming economic releases that we have for that week. On top of that as well, you also get the live stream links as well, all in one place with a playlist, rather than having to wait on Twitter or the FinancialJuice page to kind of click and or try and find the video yourself. So that's all there in one place. As I said, one email. It's not a huge email with lots and lots and lots of information that goes on for pages and pages. I prefer to give the detail via text and keep it short and concise. And then like these videos here that I'm doing with you guys now, it's to give you a more in-depth view and analysis. So you get hopefully you get the best experience out of it. But of course you have the access, you would have access to the deviations. Again, this service is free, right? If you love this service, then don't forget to sign up to the mailing list, subscribe to the channel, like the video, share it with your fellow friends and traders as well, right? If they want to kind of, jump on it with the information that I'm providing here for you, or that I've aggregated, let's say, or put together. But yeah, that's MacroAce. Then we have FinancialJuice, where I said we're going to get the text headlines appearing through here. I've turned the voice off because, of course, I want to give my analysis to what the rate is, or what's happened with the rate decision, or why they've decided to go with their rate decision. But with FinancialJuice Pro, so here we go. So FinancialJuice Pro, you get your live voice and text headlines, right? Of first of all, you have your voice here live in real time, and you have your text in real time as well, and also the economic calendar on the left hand side. So basically, all the information that you need is in one place for if you're listening into FinancialJuice. And of course, you can kind of chop and change. You can just listen into the stream, and kind of keep the rest of the window hidden somewhere else, or you can look at the whole thing and look at the text that's coming through, or just focus on the text. So that's also in real time as well. Now, if you're on the light version of FinancialJuice, there's a difference between Pro and Light, of course. The difference is that with the Pro version, you get no adverts playing. You get live real-time voice and text service and an economic calendar as well. Of course, the other benefit is that you are able to understand what's moving the markets as quickly as we can deliver the information to you to give you an understanding of what's happening, what's going on. Then, is the stream? Okay, stream's still fine. I thought the stream was lagging. But yes, so you get that real-time information as well. Now, of course, if you're a day trader, you're capitalizing on potential trades, or maybe you're managing your risk throughout the day, then having a live voice and text service is going to be very, very key and important, because you also have, this is high-level stuff that investment banks use for their trading as well. They will have an ear not only to, what is being said. Somebody said announcement in 10 minutes. We have about 10 minutes left. Thank you very much for that time. Matthew Jans, that's who you said. Said it wrong. Apologies. But you have access to that. They have access, to that with a real-time voice text service to be able to capitalize potential trades as well, or manage their risk. So the same thing here. This is high level. It's a high-level service, and that's been provided to you guys you can have a 7-day free trial of, and then make your mind up as to what you feel, whether it works for you or not. So the link is pinned at the top of the chat with the link to the 7-day free trial as well for you to have a little look at. So yeah, we've got about 10 minutes left. Here we go. Dollar is moving down. Everything's going up. So gold's going up too. Pricing in bond prices are going up as well. You can see there. So we got quite a bit left. But as said, so with the rate hike expectation, almost everyone is looking for a 75 basis point rate hike. So again, if we get something higher than expected, you'd expect a bigger depreciation from the stock market, and a bigger appreciation from the dollar. Bond prices will likely also move towards the downside as bond yields go up. Gold will also see a decline as well if the dollar flies. If we get below target rate decision, if we get a 50 basis point hike to 3.75%, then you would see the flip side reaction, where you see the dollar depreciating and the S&P 500 potentially seeing an appreciation with gold and bond prices. Bond prices heading higher. The other thing is to consider is that if the rate does come in as expected, with no significant or big surprises from the rate statement, then you might just see a bit of a whipsaw reaction on the initial candles that you see coming through. But if the statement has said something really horrid or ugly that the market doesn't like, or the market really likes, then that could also cause even if the rate does come in as expected, you could see the markets continue to move in one direction, or seeing a sustained move in one direction for each of the assets, or whichever way they go. So you can see the dollar going one way for a long time, and the S&P and so on, depending on what the Federal Reserve says. If they do talk about an early pivot, if they do talk about a pause early next year, I think it's something that has been mentioned by the Fed members, like Fed Waller, that there could be a pause early next year if data kind of meets expectations. If that's said overall, and Powell also hints that early next year, could lead to there could be a pause early next year, that could see the S&P seeing a movement towards the upside. Like I said, from my point of view, we've seen those comments come before from other Fed members, or similar comments like that. So that's one opportunity. You could see a bigger reaction, a stronger reaction from the S&P 500 appreciation, and a bigger depreciation from the dollar. Got about 7 minutes left. Somebody said 8 minutes now. Come on, guys, do a countdown with us. Michael Moosh says every second of every minute comment the change. Well, yeah, I could do that, but then it'll be very boring and I'd lose my voice. Yeah, but anyway, we have, just to let you guys know, so we have James on the microphone. James, one of our analysts at FinancialJuice, who's currently covering the mic at the moment. TICKSTRIKE here as well. If you're unfamiliar with what TICKSTRIKE is, that's providing you with measurement of order flow, or visually and audibly. So it shows how strong the buying or selling momentum is within within an asset or certain asset classes. Real Idiot said, "Are you scared or entertained?" I am both. I'll be entertained. I'll be scared if the Fed decide to go with an even bigger rate hike. But I'll be scared if they go with a smaller rate hike, because they said they want to see an additional 75. So why would they go with a 50 and then a 75? That doesn't make sense. So then, my big boy pants would be needed, right? Have you seen Captain Underpants? If you're familiar with that comic, might not be. But yeah, I feel like Captain Underpants will need an extra 3 layers to kind of cover up what's happened. But I'll be entertained, of course. All right. Let's see what we got. We have, who said rate announced? Come on, Creative Edge. Come on, don't do that. No, come on, son. Don't do that. I don't trust like that. Come on. So we got 5 minutes left. 5 minutes. Okay, I'll be back in a couple of minutes. I'm going to leave you guys to, actually, no, let me talk to you about TICKSTRIKE first. So TICKSTRIKE, as said, measures the amount of order flow, measures how strong the momentum of buying or selling is. You can see these numbers here with minus numbers. Actually, all of them minus at the moment. You can see a plus number there. There you go. So what this means is it shows you how strong the buying or selling momentum is. A minus figure shows you the selling amount, and of course a plus symbol shows you the buying amount. You have different levels of sensitivity to kind of show you an alert or give you an alert as to how strong the buying or selling momentum is. Level 1 is the most sensitive to market reactions. So when you see, a little bit of buying or selling that's going on, if it meets the trigger, then TICKSTRIKE, or the ticker, is what we call it, will go off. If you increase that level all the way to 15 or to the top, 15 is the least sensitive to market reactions. Only when there's a big amount of movement that's happening in the markets, only then will TICKSTRIKE kind of go off. So you can see here, everything else is, it's kind of moving. You can see it kind of like popping off. But here I've put it at level 15. Only when there's a big amount of buying or selling momentum, then will it kind of show me, give me a visual alert. There's also an audio alert. I've turned that off because it's quite annoying. I don't want you guys to, I don't want to burst your eardrums. Oh no, what happened? Oh. Whoops, there we go. How did that happen? All right, so I'm going to put it to level 1. So also, don't forget, so if you want a 7-day free trial, again, if you're a day trader, or you like to scalp, or you like to capitalize on potential, big moves happening in the markets, then TICKSTRIKE is there for you. Of course, you can use it however you want to use it, whatever kind of works for you. But there's a 7-day free trial link that I've posted there for you in the chat as well. All right, give me un momento, my peoples, and I'll be back. What is the White House saying now? The White House is saying the Fed is independent and Biden believes it has the best monetary policies to address inflation. Oh boy. All right, I'll be back in a minute, guys. All right, less than a minute to go, peeps. Less than a minute to go. All right. We have 580 people in the video. Hot dog! All right. Okay. See what happens. Well, as I said, keep an eye on the rate segment itself. 10 seconds left. Ha ha ha. Will it be a hallelujah moment for the markets, or will it be or be a boring rate decision? Hike, 75 basis point hike, 75 basis point hike as expected to 4%. There we go. So let's kind of have a look. Okay, there we go. So 75 basis point hike. Fed anticipates ongoing interest rate increases will be appropriate to attain sufficiently restrictive policy stance to return inflation to 2% over time. It will take into account cumulative tightening, policy lags, and economic and financial developments in determining pace of rate hikes. Inflation remains elevated. Job gains have been robust. Unemployment rate has remained low. Okay. Oof. CNQ, S&P, dollar yen, dollar going down. What else have we got? Recent indicators point to modest growth in spending and production, and they're prepared to adjust policy as appropriate. Let's see here. Oil futures edge up after Fed. I'm trying to see what's causing the dollar to weaken here. I'm trying to see what the comments have said. Let's have a look. Here we go. So it will take into account what we got. Okay. Yes. It's currently I'm still here. Trying to wrap my mind around this here. Let's see. So White House after latest rate hike says Fed actions help lower inflation. Yeah, okay. Like, because that's not obvious. There's nothing surprising from this rate decision itself. I really can't see. Could just be more or less that the hike came in as expected, and you could see moves from the S&P 500 moving towards the upside before the rate decision as well. There's no mention of there's no specific so I guess Fed says it will take into account cumulative tightening, policy lags, and economic and financial developments in determining pace of rate hikes. That could be something that the markets have taken as that they're not saying that they want to, they're not clearly taking this as an aggressive or very hawkish statement overall from the Federal Reserve. more or less quite subdued. To be fair, nothing that's come out as a surprise. But the S&P has the stock indexes have loved it. S&P, Dow. Let's have a look here. Let's go to let's go to the S&P. Let's see how much we got. It's kind of a nice surprise move. 103 ticks. Okay, it's not a big move there. I mean, it was a big move, but not as big as a move as what we've seen before. I mean, there's only about 53 ticks off. NQ 478 ticks towards the upside. Let's see the YM. Let's see, 199 ticks towards the upside. Dollar yen. Let's see what we got here. Okay, so 69 pips down. That's not 691. Don't get confused by that. Just a setting. 69 pips down. Cable, a nice reaction to 48.7. There we go. So Fed swaps downgrading the Fed swaps downgrading 75 base point rate hike in December. So I guess that's what it was. They didn't say that they would want to do another 75 in December. They kind of stuck to the guns and what they said in the summary of economic projections. They did want to see at least one 75 base point rate hike before the end of the year. So more or less, as I said, not so very hawkish statement, and not confirming another 75 for the December meeting. It's probably as to why we're seeing this appreciation from the stock indexes. Right. Un momento. All right, ladies and gents, thank you very much for joining me for the live stream of the Fed rate decision. I hope you guys enjoyed it and found that information useful. Again, not very hawkish statement from the Federal Reserve, and they took a rate hike as expected and didn't give an inclination to a 75 for December. As said, Fed swaps downgraded 75 base point rate hike in December, probably looking for a 50 at the December meeting. So I'll catch you tomorrow morning for the Bank of England interest rate decision, where there's been a lot of stuff going around with from their side. A lot of issues with the gilt market, the bank jumping in, trying to save the market, and then you had trusts essentially being fired or resigning. I think fired, in my opinion. With the way that she handled it. But let me get out the live video for you. We'll get the link for you. So this is the video for you here. So you can click on that. Join me at in the morning. So that'll be 7 a.m. Eastern time that you can join me live to trade the Bank of England. All right. Thank you very much. Take care and good night.